The Federal Reserve meets June 17 to 18, 2025 to assess the U.S. economy. With inflation cooling, but geopolitical shocks looming, the Fed is at a crossroads. In this video, we examine two opposing views, one bearish, one bullish. Which one are you leaning toward? Markets overwhelmingly expect a rate hold at 4.25 per cent 4.50%. Why the hold? Inflation in May edged up just 0.1%, lower than expected, while price pressures remain slightly above target. Meanwhile, the labor market shows signs of weakening, with soft job growth and rising unemployment. Another wildcard. The Israel-Iran war is pushing oil prices sharply higher, threatening to beat back inflation progress. In the bearish scenario, the Fed signals further rate hikes or a prolonged pause. No entry key drivers. Oil above $75 per barrel, with threats to supply fueling broader inflation. Trade tariffs and geopolitical shocks continuing to drag growth, raising fears of stagflation. Labor market softness without price stability may force the Fed to stay firm. No rate cuts until late 2025. Bullseye market reaction. Stocks slide, bond yields rise, and volatility spikes. Gold holds firm as investors seek safe havens. In the bullish scenario, the Fed hints at future rate cuts, potentially as early as September. Checkmark key drivers. Inflation cooling. Core CPI and PPI rising just 0.1% in May. Labor market easing. Jobless claims rising, wage growth slowing. Tariffs not yet showing full inflation impact. Some say downside risks outweigh inflation concerns. Bullseye market reaction. Stocks rally, bond yields stabilize or decline. Risk assets gain. Gold may pair gains as sentiment improves. Fed poster will likely refine its dot plot, showing fewer cuts needed than previously expected. Rate decision and press release expected hold, but language matters. Look for clues on inflation tolerance and timing of cuts. Dot plot projections. Will they show only one or two cuts in 2025, or none? Chairman Powell's press conference. Watch tone on growth, inflation, global risks, and war. Economic projections. Updated GDP, unemployment, and inflation outlooks, all we'll track. So there you have it. A bearish Fed prolongs policy tightness in response to global risks and inflation. A bullish Fed leans dovish if inflation cools and labor softens. Compass. Which scenario do you think the Fed will signal? Let me know in the comments. Checkmark like, subscribe, and hit the bell to stay ahead of market-moving Fed news.